Welcome to the Deep Dive. This is where we take a whole stack of reports, news, market insights, all that dense stuff, and really dive in to pull out the key nuggets just for you. Today, we're tackling a big one, ARM Holdings, ticker ARM. You hear the name everywhere in tech, but maybe you don't fully grasp what they do, especially as an investor. So our mission, we're going to unpack all this analysis we've gathered, investor reports, news clippings, and give you that clear shortcut, make you feel really well informed about ARM. Okay, let's unpack this.
Yeah, and what's fascinating here is just how central ARM is. I mean, it just touches almost everything digital, right from your phone to the cloud servers. And specifically for you, listening as an American investor, we want to cut through all that noise, just distill this down to the actionable insights you actually need for your investment journey.
Okay, let's jump right in then. Usually when we talk chips, Qualcomm, Apple, NVIDIA, those names pop up. But ARM, they're not actually making the chips, are they? So for someone maybe just vaguely familiar with the name ARM, what is it they actually do? And maybe more importantly for us investors, how do they make money if they're not manufacturing anything physical?
That's exactly the right question. And it's kind of the key to understanding ARM's whole business, their genius, really. ARM is fundamentally an intellectual property company, an IP company. Think of them like the architects, the master planners behind the scenes. They design the core blueprints for microchips, the instruction sets telling a CPU what to do, or how a GPU, a graphics processor, should work. Then they license these designs, these blueprints, to all those companies you mentioned. Hundreds of them worldwide. Apple, Samsung, NVIDIA, Qualcomm. They all use ARM designs. So their business model has like two main parts. First is the IP design and licensing. Companies pay an upfront fee, basically, to get access to ARM's latest architectural designs. But the really powerful part, that's the royalty model. They don't make the physical silicon. No. Instead, when a company like Apple uses an ARM design in their chip, ARM gets a royalty, a small fee for every single chip that ships with their IP inside. It's like, imagine a songwriter. They write a hit song, they don't press the CDs or stream it themselves, but every time it gets played, boom, royalty. ARM does that, but for billions and billions of chips every year.
Wow, okay, billions. So that's where the scale comes in.
Exactly. And this model creates what I call their really strong moat, their competitive advantage. First, you've got their market share in mobile. It's over 90%. That's practically a monopoly. Almost every smartphone uses ARM. Second, their famous energy efficiency. They started focused on mobile, needing low power, and now that's a massive advantage in power-hungry data centers, and AI has become crucial. And third, just the sheer size of the ecosystem built around them over decades. Software developers, tools. Trying to switch away is like asking a whole city to learn a new language and rebuild everything overnight. It's a huge barrier for competitors.
The master architects with a serious moat. I like that framing. Okay, so dominant in mobile, check.
Sure.
But a company this big needs growth, right? They can't just rely on smartphones forever. Where is ARM looking for that next big wave? Where's the future expansion?
Yeah, you're spot on. Mobile is the foundation, absolutely. But they've been really smart positioning themselves for the next big tech waves. First off, and this is huge for investors, data centers and the cloud. Big cloud players, AWS with Graviton, for example, they're rapidly adopting ARM-based server chips. That's a major shift away from the traditional server architectures, a really big deal.
Okay, so they're moving into the cloud giants territory.
Right. Then, number two, AI and machine learning. ARM's architecture is popping up more and more in AI chip designs. We expect a lot of growth there, both in edge AI processing on the device itself and, on-device AI in phones and gadgets. Third, automotive. Cars are packed with electronics now. ARM's IP is all over that, from driver assistance systems, ADS, to the infotainment screens. Huge growth there. And finally, the sort of sprawling Internet of Things, IoT, smart homes, wearables, all those connected devices, ARM is right at the core. So yeah, these aren't just small side projects. They're tackling massive growing markets.
That really paints a picture. It's not just phones anymore. It's AI, cloud, cars. A fundamental shift.
Right.
Okay, so if that's the strategy, let's talk money. What does the financial engine look like? And just a quick reminder for you listening, we're using estimated 2025 figures here based on 2024 results and consensus views. Always check the latest official filings before making any investment decisions.
Right, good reminder. So based on those estimates, ARM's financials look, well, pretty attractive. It's what you'd expect from a successful IP company, really. Revenue breaks down into two main buckets. You've got license revenue, that's about, say, 30–40% of the total. Those are the upfront fees companies pay to license ARM's IP. This part can be a bit more variable, depending on new tech launches or big design wins, especially in hot areas like AI.
Okay, upfront fees.
Yeah.
And the other part,
that's the bigger slice, the royalty revenue, usually around 60–70%. This is that steady stream we talked about, the fee for every chip shipped using their IP, smartphones, IoT, cars, servers, all of it. It's more predictable, more like recurring income. And what's really key here is the profitability. Because they sell blueprints, not physical stuff, their cost of goods sold is super low, tiny almost.
Right. No factories, no material.
Exactly. So that means their gross margins, their operating margins,
Yeah.
they're exceptionally high. It's a fantastic business model from that perspective. And that structure leads to really strong cash flow. The steady royalties generate a lot of cash, which lets them reinvest heavily in R&D, which they absolutely have to do to stay ahead and potentially return cash to shareholders down the line. Their balance sheet is generally healthy too, not a lot of debt.
And how have they been doing recently, like the last fiscal year?
Yeah, so fiscal year 2024, which ended back in March, they actually beat expectations. Revenue was strong, largely thanks to a jump in that license revenue, probably driven by all the AI and data center buzz. Their earnings per share, EPS, also came in better than expected. Good cost management alongside the revenue growth. And their guidance for FY 2025, the outlook, was positive too, still emphasizing growth in high-performance computing and AI.
Okay, strong financials, high margins, good growth outlook.
Yeah.
So how should investors think about the stock price and its valuation? Because that kind of profile usually comes with a pretty steep price tag, doesn't it?
It often does, yeah. ARM is definitely seen as a high-growth stock, so you need to look at its valuation metrics through that specific lens. You'll almost certainly see a very high price-to-earnings ratio, the PE. For a growth stock, that's not automatically bad, you know? It just means the market has high expectations for future earnings baked into the current price.
So it's pricing in future success already.
Pretty much. The price-to-sales ratio, PS, can be more helpful sometimes, comparing ARM to similar IP or software companies where sales growth is the main story. And another one people look at is the PEG ratio, that's price to earnings to growth. It tries to factor in the growth rate. Ideally, you might look for a PEG closer to 1, but with high flyers, it can often be higher. Ultimately, for ARM, the key things to watch is that revenue growth continuing, especially from AI, data centers, auto, and are they maintaining those really impressive operating margins? That's the core story.
That makes sense. Context is everything with valuation. But, stock doesn't live in a vacuum. It reacts to news, industry shifts, even global stuff. What are those external market drivers constantly pushing and pulling on ARM's stock price?
Oh, absolutely. You can think about it in layers. Tier 1 is ARM-specific news. Any big announcement about a new AI deal, a data center win, maybe AWS or Google Cloud signing up for more IP that moves the stock. Also, news about their tech roadmap, like the ARM v9 architecture for high-performance computing and AI. That shows they're staying ahead. Updates on their progress in automotive and IoT matter too. And then there's the flip side. SoftBank's stake. They're the biggest shareholder. If there's talk of them selling a large chunk of shares, that could put pressure on the price. And of course, the market is always watching the RSCV competition. How serious is that threat?
Okay, so ARM news first. What's the next layer out?
Tier 2 would be semiconductor industry trends. Right now, the huge demand for AI chips is a massive tailwind for ARM's IP, especially for GPUs and NPUs, the neural processing units. Continued investment in data centers by cloud providers directly fuels ARM server chip adoption. Growth in automotive chips for EVs and self-driving, that's another positive. We do need to acknowledge the smartphone market is maturing, growth is slowing there, which is ARM's biggest royalty source today. But the trend towards more powerful premium chips means the average royalty per phone might actually go up.
Interesting. So quality over quantity there.
Sort of, yeah. And one more subtle thing, foundry capex. When giants like TSMC and Samsung spend billions on new advanced factories, that's actually good for ARM. Their latest IP needs those cutting-edge processes.
Got it. So industry trends. What's even broader than that?
Tier 3, broader tech industry trends. Things like overall digital transformation and cloud computing just lift the whole data center market, helping ARM. The rise of edge computing and on-device AI. ARM's power efficiency is perfect there, opening new doors. Even future stuff like the metaverse or XR devices, they'll need powerful, efficient processors, potential new demand for ARM blueprints. And then you have global tech regulations, supply chains. The US-China tech tensions, pushes for national chip production. ARM is global, so it's sensitive to all that.
Right. Geopolitics always plays a role.
Yeah.
And the final layer, the biggest picture.
Tier 4, global macroeconomic trends. Basic stuff, really. Global economic growth affects IT spending and consumer gadget buying. A slowdown hurts. Inflation and interest rates are big for growth stocks like ARM. High rates make future profits less valuable today, potentially hurting the stock price. Exchange rates matter for any global business. And just general consumer and corporate sentiment. Are people and companies feeling confident enough to buy new devices or invest in R&D? It all connects.
Wow. That's a lot of interconnected factors.
Hmm.
It really shows how ARM sits at this nexus of tech, industry, and the global economy. Okay, so it has these incredible tailwinds, but you mentioned risks like competition and SoftBank. Let's focus on that. For the investor listening, what are the key risks they really need to keep front of mind? And how does ARM fight back? What protects that moat you described?
Yeah, absolutely crucial to weigh the risks. Number one is probably that high valuation we talked about. Expectations are sky high. If ARM stumbles, if growth disappoints even a little, the stock could fall significantly just because so much success is already priced in.
Okay, valuation risk. What else?
Competitive intensity, mainly from RISC-V. It's an open-source alternative architecture. It offers potential cost savings and customization, which could make it attractive, especially maybe in IoT or embedded systems initially. And don't forget, Intel's x86 is still a major force in servers. ARM isn't alone.
RISC-V. Okay, keeping an eye on that one.
Then there are geopolitical risks and trade disputes. Being global is great, but it also means exposure if tech exports get restricted or trade wars heat up. We mentioned SoftBank's divestment risk. If they decide to sell more of their large stake, it could flood the market and push the price down, at least temporarily. And finally, just the risk of rapid technological change. What if some completely new computing approach emerges, like quantum computing becoming practical faster than expected? ARM needs to constantly innovate to avoid becoming obsolete.
So those are some pretty significant headwinds to watch.
Yeah.
But ARM isn't just standing still, right? What are its core strengths, the things that push back against those risks? What is that moat, really?
Right, they have powerful defenses. The biggest is that overwhelming ecosystem. Decades of software written for ARM, millions of developers who know it, all the tools. It's this massive, self-reinforcing network. It's incredibly difficult and expensive for customers to switch. That's a huge barrier to entry for RISC-V or anyone else.
The sheer inertia of the ecosystem.
Exactly. Then there's their fundamental strength, superior power efficiency. That's just baked into their DNA, and it's increasingly important everywhere, not just phones. Data centers, AI, IoT efficiency matters. They also have a proven track record of continuous technology innovation. They keep releasing new, better architectures like ARM9. They invest heavily in R&D to stay ahead. Their broad customer base is also a strength. They license to hundreds of companies globally. They're not overly reliant on any single customer, which reduces risk.
Diversification. Makes sense.
Yeah, and the IP licensing model itself is inherently strong. High margins, doesn't require massive capital for factories, it's capital light. They're also very good at attracting top engineering talent, which is critical. And, increasingly important, their designs contribute to ESG goals through energy efficiency. That matters more and more.
That moat really does seem multifaceted. Okay, briefly then, let's touch on technical analysis. Now, obviously, we can't give real-time advice or look at today's chart, but conceptually, what do investors look for on a chart for a stock like ARM?
Conceptually, right. So investors might look at support and resistance levels. These are price points where the stock has historically tended to stop falling, support, or stop rising, resistance. They can indicate potential turning points. They also look at moving averages, the average price over a certain period, like 50 days or 200 days. How these averages trend, and especially when a shorter-term average crosses a longer-term one, can signal potential trend changes. You hear terms like golden cross or death cross. Volume is another one. Is trading volume high or low when the price moves? High volume can suggest stronger conviction behind the move. And then you have oscillators, things like the RSI or MCD. These try to measure the momentum of price movements and can suggest if a stock might be overbought or oversold in the short term. But the really important thing is context. Never use just one indicator in isolation. Look at the whole picture, combine it with the fundamental analysis we've been discussing.
Right, tools in the toolbox, not a magic crystal ball.
Precisely. So wrapping this all up for you, the American investor looking at ARM Holdings. Let's summarize the investment thesis. The positives are compelling. ARM is essentially AI infrastructure. It's got strong growth momentum, particularly in cloud data centers. It boasts high profitability and stable cash flow. And that ecosystem moat is incredibly powerful. It's a central player.
Yeah.
But yes, there are significant considerations. The valuation is very high. A lot of good news is already priced in. There's real, albeit maybe long-term, competition from RISC-V. ARM is exposed to macroeconomic cycles, and SoftBank's stake remains an overhang, a potential source of share supply.
Okay, so weighing those pros and cons, what's the strategic takeaway for an investor based on the analysis we've reviewed?
The analysis suggests a few key strategies. First, take a long-term view. Don't get too caught up in short-term swings. See ARM is benefiting from huge multi-year trends. AI, cloud, IoT, automotive. It's likely more of a foundational holding than a quick trade.
Makes sense. Play the long game.
Second, exercise valuation caution. Because the price is already high, be careful about your entry point. Maybe consider dollar cost averaging, buying smaller amounts regularly over time, or look for opportunities to buy during market pullbacks or dips, rather than chasing it higher.
Don't FOMO in at the peak.
Exactly. And finally, monitor the key trends constantly. Keep watching the competitive landscape, especially RISC-V. Track ARM's own tech roadmap are they delivering, and scrutinize those quarterly earnings reports. Does the actual performance back up the growth story? Verify.
So here's a final thought to leave you with. As our digital world demands ever more efficient processing, everywhere from the cloud to your car to your wrist, just how much more runway does ARM have to grow as the blueprint provider, even with new challengers starting to emerge on the horizon? Thank you for joining us on this deep dive into ARM Holdings. If this deep dive was helpful to you, please subscribe.